Hey there! Welcome to an eye-opening journey into the world of financial literacy. Today on Master Wealth, and in this insightful guide, we're diving deep into the nuances of money, economics, and strategies for building wealth. But before we dive in, don't forget to hit that like button and subscribe to our channel for more valuable content like this. Throughout this session, we'll unravel the mysteries behind the value of currency, the impact of economic shifts on our daily lives, and the indispensable role of the Federal Reserve on our monetary system. This video touches a lot more on foundational subjects like the Federal Reserve's part in the monetary supply as well as its linkage to the government and investors. Join us on this illuminating expedition to master the art of assets, liabilities, investments, and securing your financial future. So, let's get started and make sure to hit that like button and subscribe to stay updated with our financial insights and tips. The government is known for its money spending, its money borrowing, and its money printing. But for Americans, one of the biggest expenses that we have is taxes. And that might have you wondering, if the United States government can print and spend whatever amount of money that they want, why do we have to keep paying taxes? They can print our tax revenue faster than we can pay it. Take a look. In 2022, the United States government collected about $4.9 trillion in tax revenue. You can compare these taxes collected with the amount of money that the government printed during the era, which was somewhere between 5 to 7 trillion, depending on who you ask. Now, it doesn't take a math genius to understand that the second estimation of numbers is bigger than the first number mentioned, which means that, wait, if the government is printing or has printed more money than what they generated in taxes, can't they just print this money so we don't have to pay this money in taxes? So Americans can have more money to pay their bills, invest in themselves, pay down debt, and save. Well, it's not so simple. To really understand this, these are 4 things that you have to understand. Number 1, who is actually doing the money printing? Number 2, this idea of power and control through taxes. Number 3, the idea of taxes being collateral. Number 4, the impact of printing so much money. We're going to go over each of these 4 items in this video. So, let's start by understanding who does this money printing in the first place. We have the government, made up of a lot of different departments, one of which is the Treasury Department. And within the Treasury Department, you have the IRS. Now, the IRS is the agency that's in charge of collecting taxes. When you send your taxes, you're sending it to the IRS, which is a part of the Treasury Department, which is part of the government. So, the IRS is in charge of collecting taxes. Then, the Treasury Department comes up with the ideas on how to get more money and how to spend that money. To be clear, the Treasury Department is influenced by other departments in the government about how to spend that money, but the Treasury Department is the money control center of the United States government. However, what we've been seeing happen year after year after year is that the government keeps spending more money than what they generate through taxes, meaning the IRS is collecting money, but the Treasury Department is spending more money than what the IRS is generating. So, where does the government actually get this money from? Where does this money printing happen? The money printing actually doesn't happen in the Treasury Department, which is part of the government. It happens with the Federal Reserve Bank. This is known as the central bank in the United States. And while they're called the Federal Reserve Bank, they're actually not federal. They're not a part of the United States government. They're supposed to be an independent entity. It even says so on their website, so feel free to check that out to dispel any doubts if there are any. They're not a reserve because they don't keep any cash reserves anywhere. And they're not a bank because you and I can't go there to deposit money. However, what the Federal Reserve Bank can do is they have influence over our monetary system. meaning they have the ability to essentially print money and control interest rates. So now, when the government, through the help of the Treasury and the IRS, wants to spend more money than what they're generating, they have to go and get this money from somewhere. They're going to have to go out and borrow this debt. The place where the government can get this debt is either by borrowing money from people like you and me. To further explain this point, when you and I go to buy things like treasury bonds, treasury bills, and notes, that means we are lending money to the United States government. But if the government is issuing too much debt, meaning they need too much money, then they can go to their friends at the Federal Reserve Bank and say, "Hey Fed, can you lend money to the United States government by buying this debt?" So it's the Federal Reserve Bank that's now going out and buying these treasuries, bills, and notes, ultimately lending money to the United States government. Now, if you remember what we spoke a minute ago, the Federal Reserve Bank doesn't have any reserves. They don't have piles and piles of cash just laying around that they can give to the United States government. They have the ability to create this money. So, when the government wants to go out and issue debt and the Federal Reserve Bank is buying the debt, that means the Federal Reserve Bank has to then essentially print this money and lend it to the government. So, the entity that's printing the money is not the government, it's the central bank, the Federal Reserve Bank. They create this money essentially out of thin air and they lend it to the government, who then has the ability with the Treasury Department to spend this money, in addition to the tax dollars that they generated. This brings us back to the original question. Why do we need the IRS in the first place if the government can just borrow money from the Federal Reserve Bank? Because they're clearly already borrowing trillions and trillions of dollars from the Federal Reserve Bank. So why do we need this IRS entity to collect taxes from American people, businesses, and investors? Well, this brings us to point number 2, which is understanding power and control. Because if the government now imposes a tax on people, that creates more power to the United States dollar. Because remember, everything that's happening here is based off the United States dollar. And one of the ways that the government can create more value out of the United States dollar is by making sure that all transactions are happening through the United States dollar. Because when you go and you pay taxes, you're not paying taxes in gold. You're not paying taxes in pesos. You're not paying taxes in rupees. You're paying taxes in United States dollars. So, this is a way to incentivize people to work for dollars and pay taxes in dollars, which creates more value around the United States dollar, which is the world's reserve currency at this time. And it also creates power over people because the government has the ability to encourage and discourage certain things through taxes. Like, if the government says, "We don't like when people smoke," they can impose taxes on cigarettes to make it less attractive for people to smoke. And so now, the government can impose things and discourage things by imposing taxes. So, it's a way to kind of keep power and control over people and its currency. Third is what we call collateral. Now, think of it this way. If you want to go out and get a credit card, how do you get approved for a credit card? Well, they're going to ask you how much money you make and what liabilities you have. The more money you make, the more revenue you have, the bigger the line of credit that you're going to get. With that in mind, the credit card company is looking at your income kind of like collateral. Because if you're making a lot of money, then you should have the ability to pay back a bigger line of credit or credit card. Because if you spend more money, will you have more money to pay off this credit card? It kind of works the same way with taxes because now the government is working to generate their revenue, if you want to call it generating revenue, but they're generating their taxes through the IRS, meaning Americans, American businesses, American people, American investors are going to work to generate revenue. Now, as you work to get paid, some of this money is going directly to the IRS, which is a part of the Treasury, which is a part of the government, which means now the government can show we have ABC income, We made $4.9 trillion worth of revenue in 2022. Now, again, just like with a credit card, the more income that you can show, the more credit that you can qualify for. So now, if the government is showing more income, they're showing bigger tax revenues, they will have the ability to go out and borrow more debt. Now, you might say, well, won't the Federal Reserve Bank always just fund whatever the government wants? Well, in theory, that's what we've seen happen. Remember, it's not federal. It's not supposed to be a part of the government. So, there's supposed to be some level of independence where the Federal Reserve Bank has to look at the balance sheet of the United States government. They have to look at the P&Ls, the profit and loss statements of the United States government, and then make a decision on whether or not the United States government is a worthwhile investment to keep sending their money into. Not to mention, the government also has other investors outside of the Federal Reserve Bank, like regular people. People like you and me can lend money to the government, and other countries like China and Japan are lending money to the United States government. So, all these entities that are lending money here in the form of debt to the government are going to look at what the government has in terms of collateral, aka tax dollars. It can aid the strength of the economy because now, when they make their lending decisions, they want to see, can the government continue to pay back their interest? Can they pay back this debt? That is the question that every investor, whether it's the Federal Reserve Bank, whether it's regular people, whether it's other countries, are asking. So, this tax revenue that the government is collecting is that form of collateral. And then you have number 4, the impact of this money printing, the impact of this debt. And let me start with the more obvious impact of this by showing you a chart of the United States government's expenses. This is directly from the Treasury Department showing the top 10 areas where the government spends their money. Those are the top 10 places where the United States government is spending their money. Again, they're getting their money from taxpayers through tax dollars and through this debt. But the more interesting part here is, which one do you think is the fastest growing expense for the United States government? And here's a hint. It's not Social Security, and it's not national defense. Even though you have a lot of wars going on in the world, it is the interest expense. It is the amount of money that the United States government is paying in interest on all of their debt. In fact, it is expected or forecasted that the interest payments that the government has to pay on this debt will exceed our entire military budget by 2028. So, what does that mean? In short, the government is collecting dollars from 2 different places. They're collecting dollars from taxpayers through tax dollars, and then they're collecting dollars from debt. And where's the money going? Well, it's going through those 10 expenses that I just talked about. But the fastest growing expense is this interest expense to pay back all this debt that they generated. This is not only the fastest growing expense, but this is going to be one of the largest expenses for the entire United States government in the coming years and decades. Now, part of the reason for that is because the government has been borrowing more and more dollars. And the second reason for that is because the interest rate on this debt is also rising. So, it's double the negative impact. You're borrowing more dollars, and then you're paying more money to borrow each one of these dollars. With all this in mind, you can start to see where this becomes an issue, because now, as the government goes out to borrow more money, you have all these investors like the Federal Reserve Bank and investors like you and me, and investors like other countries saying, well, will the government continue having the ability to pay back this debt? And if 10 years from now or 15 years from now or 20 years from now, the government starts to struggle because, well, they're not generating enough money from tax dollars, you can start to see where that would pose a bigger issue for the government, for the economy, for the dollar. And this is where now the government has to make the decision of, are they going to cut back on some of these expenses, which they are paying? because that means they might have to cut back on things like social security or health care or other welfare benefits or entitlements, or maybe national defense. They might have to cut back on some of these things, which means people could lose incomes, people could lose jobs, businesses could make less money. But the alternative is they keep spending more and more money without generating more tax dollars and relying more on debt. We don't know the right answer. We think the conversation is tough, but it's one that needs to eventually happen. But that's why it's important for you to stay up to date on this kind of issue, especially as you make your way to your financial destination. This is why we do our best to become a resource that you can use to navigate your journey a bit smoother. So keeping up with this sort of information and making adjustments to plans and actions is relevant to your success. Now, you know from a customer perspective that if you just keep spending more money, but money you don't have through your credit cards, and you pay back one credit card with a second credit card, you can see the impacts of that. Well, how long can the government last? Well, only time will tell. And so, this is the first impact of constantly spending money that the government doesn't have. The costs of borrowing money keep going up. The fastest expense for the government is interest expenses. The second cause of spending money that the government doesn't have is what many of us in the financial space like to call the hidden tax. Now, regular tax is pretty obvious, like when you go to work and you get paid. That tax is obvious. You've got to pay your employment taxes, your FICA taxes. You've got to pay your income taxes. That's obvious because that gets taken out of your paycheck. When you make profit in your business, you've got to pay taxes. That's obvious. When you make profit from your investments, you've got to pay taxes. That's obvious because you realize that this money is leaving your account and going to the government. But then you have the hidden tax, which comes from the money printing. Because if you just keep printing more and more money, if you create more units of dollars, what happens to each other individual unit of dollars? Like, if you have $100 in your bank account and the Federal Reserve Bank keeps increasing the amount of dollars out there, what happens to the value of the $100? Well, what has happened? What we've seen happen is that the value of the $100 that you have goes lower and lower and lower. Just think about how $100 could have been spent 5 years ago versus today. $100 in a grocery store 5 years ago could buy you more than what $100 can today. And if you project back a few decades, $100 in the 1970s could buy you way more than what $100 can today. Why? Because the Federal Reserve Bank, over the last number of decades, has been working to increase the amount of units out there, increase the amount of dollars out there. Our currency, our dollars, are not backed by any precious metal like gold anymore. They were backed before the early 1970s, but now it's not. So, now as you increase the amount of currency, you increase the amount of units out there, you increase the amount of dollars out there, the value of each individual dollar goes down, causing the price of things to go up. Now, the reason why the prices of things are going up isn't just because it's more valuable, but because the currency that you're using to buy that item, to buy that thing, is becoming less and less valuable. So, you need more dollars to go and buy that thing. So now, who does that hurt? That hurts savers. Because if you're just saving your money and your money's not growing, well, then that means your savings are staying at the same level while the prices of things are rising above the level. And if you're just relying on a salary that's not growing fast enough to keep up with the inflation, the hidden tax, well, now you might be getting raises, but it's not keeping up with the more expensive groceries, the higher housing costs, the higher cost of living. And this is what we've been seeing happen in America. Not just over the last few years since the pandemic, but since the early 1970s. And this is where the financial education becomes so important because the people that benefit are the people that own things. It's the people that own real assets because what has gone up in price? Well, the prices of things like real estate, the prices of things like paper assets, like stocks. And so, the asset owners are benefiting because the value of these assets are going up. Even if the value is not going up, the cost to buy these assets is going up because the value of the dollar has gone down. And this is where financial education, again, becomes so important because the people that understand this get the benefit, and the people that don't understand this, which is the vast majority of the country, the vast majority of the world, they're the ones that are paying the price. And so, once you understand this, the question is, what do you do? And this is where it becomes important for you to start spending some of your money to own some assets. That way, you can benefit from the way that the economic system works, because the reality, this is what has been happening. There are impacts to this, and this will continue to happen. So now, as this continues happening for the next 5 years, 10 years, 20 years, 50 years, well, you gotta think, what's happening to the economy and your money? And you want to start protecting yourself, your family, and continue to build your wealth. That way, you're not the person that's just making everybody else rich, but you have the ability to build your own wealth. The reality is, we're all working to earn dollars in this economic system. And if you want to maximize the impact of the work that you're doing and the dollars that you're generating, you have to understand what to do with your money. You have to understand how to spend your money. You have to understand how to invest your money. That way, you can actually win in this financial system. And while you might be very good at earning an income, you have to know how to use that income to actually build real wealth. Because your wealth is not built through your salary, it's built through your assets. If you want to get your finances in order, the first thing you need to do is not to hire an expensive money coach or financial planner or financial advisor. The first thing you need to do is just track your money. Once you track your money, you want to make some adjustments to know how you're spending your money. Once you make those adjustments, make sure you implement those adjustments and then rinse and repeat. If you've enjoyed this video, don't forget to like, comment, subscribe, and share if you think someone will appreciate it as much as you do. As always, see you in the next video. Cheers!